Lunch. We've got no lunch, but we've certainly got the power. It's Michael Power from Investec Asset Management, strategist at that institution based in Cape Town, sometimes based in Cape Town. Anyway, you're all over the place, Michael, and capital's all over the place because you sent me your latest presentation, The Great Migration of Capital. You say a great divide characterises the world of finance today. 80% of mobilised capital still in the West, whereas only 20% is in the rest. Yet with 80%, you say, of global GDP growth in the next decade, according to you, coming out of the rest, which has the 20% which you just mentioned, and only 20% for the West. The question immediately arises, to what degree, you say, the first 80% will participate in the second? Why is this so important? There's obviously these great discrepancies between growth and mobilised capital.
Well, I think that much of the capital that's sitting in the West at the moment is essentially scared and probably first and foremost looking to preserve itself. But that bit which is starting to seek growth is starting to realise it's not going to find it at home. It needs to overcome home bias and start moving out of its comfort zone and start moving into the rest of the world. And quite a small migration of capital could end up making rather a large difference. Some other questions that arise are, to what degree will the rest let that capital in? And I was in Brazil last week, and that's a classic example of a country that has two minds about whether it wants to welcome huge amounts of foreign capital. And more recently, the question is starting to arise, to what degree might the West let that capital out? And the behaviour, for instance, of France recently would start to indicate that they're in two minds as to whether they would want their capital to migrate somewhere else.
It's interesting, isn't it? Is there a psychological barrier, do you think, that people in the West, the old world economies, the so-called developed economies, and they are developed, but they're becoming less developed, in my opinion, and the ones that a lot of people are still sceptical about are the developing economies, who are developing very, very fast. But is there some kind of, as I said, a psychological barrier as to the enormous shift there's been over the last 20, 30 years?
I think there's a denialism, especially in the Anglo-Saxon West, as to the degree of change that's around. Interestingly, countries like those of Scandinavia are not operating on this denialism, and they're starting to move quite a lot of their capital into the new world. So it's not universal across the West, but in the United States in particular, you can't have a decent conversation about frontier markets, but go to Helsinki or Stockholm and it's as easy as you can imagine.
Is it because they're not informed, or is it because, as you quite rightly say, there is the denialism factor?
It's called home bias by economists, and there is this sense, and one watches it on television, the degree to which Americans invest in America and can't believe that they should ever think about really investing beyond it.
Well, Americans are always like that. They're xenophobic, first of all. They're not great travellers. I think only 16% of Americans have passports. Well, that was a statistic I saw a few years ago. It's probably updated now. And the fact that they play baseball and American football and very few other jurisdictions do so tells you something about the Americans. Well, where should we put our money? A lot of people will say, well, China's one thing, but it's just a flash in the pan. Okay, it's been a 30-year flash in the pan, but look, the growth rate is coming down now to 7.6. It was close to 11 not so long ago, so therefore it's all over. There's a property bubble here and there. There's ghost towns being built. So don't give up on America and these other stodgy old places.
Look, I don't think that you necessarily have to think that China is the only game in town, and I think that it'll probably, at some point in the next decade, especially when you see a liberalisation of the renminbi, become a place where capital is going to flow, and indeed they're giving every indication of welcoming capital. You may have seen last week they actually cut taxes on foreign firms operating in China, and every week there's a new welcome to China capital liberalisation law that comes out. So I think at some stage in the next 10 years, and I would tie it in with the liberalisation of the renminbi, you're going to see a lot more capital going into China. But at the moment people are in two minds as to whether it's the right place to put it. They're trying to play the China game often by not investing in China, so that might mean buying companies in the West that are investing into China, or buying products that are made in South Africa, Australia, or Canada that are being sold to China. But a lot of people are actually avoiding the China game front on. There are plenty of other opportunities beginning to emerge, though I have to say for the next 6 months, given the fallout that is likely to take place first and foremost in Europe, and secondly as a result of the looming fiscal cliff in the United States, I'm not sure I would be wanting to put my money anywhere at the moment other than in the safest of assets. But I do think you should be doing a lot of homework in the next 6 months to find out, as and when the dust does start to settle, where should you deploy your capital?
I didn't want to bring this up until the end of the interview, but when you talk about safe havens now, I mean, I look at the German Bund. and I say to myself, there's been so much money going into the so-called safe haven bond markets, so characterised by the Bund. But I'm suddenly seeing all these articles, and I think the FT is one this morning, which talks about the fact that actually the German Bund might be a bubble, and it's probably the least the long end of the German yield curve may actually be the least safe place over the next year or so.
There's a counter-argument which I think is rather interesting, and that is that were the euro to fall apart, the German Bund would probably be redenominated back in Deutschmarks, and there's a potential 40% appreciation that would come through from the Deutschmark, if not the Bund itself, that would then allow you to essentially buy into that option. So there is this optional value attached to the Bund that is quite difficult to put a price on. But were Armageddon to happen in the Eurozone, you may see some quite heavy appreciation in value terms in the Bund.
China now. The reason I mentioned China was because for the last 5 or 6 years, the interviews that I've conducted with you, I've had to stop you after about 10 minutes, waxing lyrical about China. Is this still a place to be? And the reason I ask this, and it's a very simplistic question, is because the Shanghai Composite Index that I watch every single morning on CNBC touched a near 3-year low just 2 days ago. Is that misrepresentative of the Chinese economy?
No, I just think it's part and parcel of what tends to happen when a big change takes place. I mean, interestingly, from the post-Civil War in the United States, 1865 through to 1914, there were, for long periods of time, it was a waste of your money to try and put it into the United States. But the United States was the game in town when it came to the transformation of the center of gravity in the global economy. So I think China's experiencing somewhat of a similar situation at the moment. I do think, and I've said just now, that as and when the renminbi starts to liberalize, that a sea change will take place in terms of investors' attitudes towards China, and we will probably see more gains than losses from that point onwards.
Okay. The situation in Greece now, some people have sort of have pushed Greece aside and said, well, now it's Spain, and now it's Italy, and it's Sicily, and it's Cyprus, and it's all coming to a head now. But Greece quietly is moving out of the Eurozone. Surely now the Troika are there. As we sit and speak now, the Troika of the EU, the ECB, and the IMF are now saying to them, you've got to do more. And the ECB, you've got to take haircuts on your bond investments in Greece. And it all seems to be unravelling to me. And it's almost as though from the rhetoric that they are wanting Greece to move out. They're saying, look, we've more or less given up now, so let's do it in an elegant way. Do you get that feeling?
I absolutely get that feeling, and I feel as though to some extent they're actually trying to create a condition which Greece cannot meet in order for themselves to be able to say goodbye.
Yeah.
And I think that the banking systems are sufficiently, as best as they will be anyway, prepared for the possibility of a Greek default. And I think that a lot of the politicians have essentially resigned themselves to the idea that there will be a Grexit.
So it's not just me. I mean, the rhetoric has indicated that, hasn't it?
Yeah. But I would say that then follows the possibility, the likelihood of a Cyprus exit, which is intimately connected to the Greek economy, a Portuguese exit, possibly even an Irish exit, and then of course the biggies of Spain and Italy. And really the real focus of attention at the moment is happening on Spain and somewhat beginning to happen on Italy as well.
Michael, thanks so much for popping in this